Anthony Grasso here, bringing you financial news that you could use. In this particular video, I'm going to do a stock analysis on Orbital Infrastructure Group. Is this Nasdaq deficient whack-a-mole revenue chasing, forever not profitable, shareholder diluting company worth investing in right now? Basically, can their 2021 turnaround strategy actually work? I remember the greatest turnaround story of all times. That was George Clooney in the movie The Perfect Storm. And we all know how that turned out. Well, let's find out together. I did the stock analysis video on this company over a year ago now, and I was a sell recommendation 1 year ago. So I'm curious on if I changed my mind over the past year. Have they gotten any better? Well, I'm going to go over a summary of the company, its product offerings, recent headline news, financials, analyst projections, and then finally I'm going to give it my buy, hold, or sell recommendation for both your short-term and long-term growth investors out there. And as always, folks, don't forget to smash that like button down below. Definitely helps. And consider subscribing. Hit that notification bell if you'd like to hear daily stock reviews and recommendations from an unbiased source. So let's get right into it. As always, folks, this video is brought to you by Webull, which is an online brokerage trading platform where you can buy stocks, options, ETFs, and cryptocurrencies. Now, if you sign up today and deposit any amount, you get up to 12 free stocks by using my referral link in the description down below. All right, so let's start off with this summary of this company real quick so everybody's on the same footing. Now, the company formerly known as Orbital Energy Group is a diversified infrastructure services platform. Now, what they do is they provide engineering, design, construction, and maintenance services to customers in 3 operating segments. Now, they sold off one of them, and they're left with 3. They have the electric power now, telecommunications, and renewables. So think of the company as a holding company that purchased what they believe are strategic companies. So let's look at some news of the company right now. Well, the company did announce back in August 1st that they rebranded itself from to Orbital Infrastructure Group to align with the company's infrastructure strategy as a continued expansion and market diversification. Now, back in July, this is some bad news. Now, it received a notice from Nasdaq indicating that the company is not in compliance with their $1 minimum bid price requirement. Now, for the company to regain compliance, the closing bid price of the company's common stock must meet or exceed $1 per share for at least 10 consecutive days before January 16th, 2023. But don't worry, if they don't meet compliance by January 16, 2023, the company may be afforded another 180-day extension to regain compliance. That means that would put them off to July to get compliance to remain on the Nasdaq. Now, to qualify for this, the company would have to be required to meet continued listing requirements for market value of publicly held shares and all the other initial listings standards for the Nasdaq capital market, except for the minimum bid price requirement, of course, until they got it up. In addition, the company would be required to notify Nasdaq of its intent to cure the minimum bid price deficiency, which may include implementing a reverse stock split. And everybody knows that. That's not a good sign for a company when they do a reverse stock split, at least in my opinion. And it hasn't been normally. So what does all that mean? It basically means if they eventually get delisted, they would be then pushed over to the over-the-counter exchange, which is called the pink sheets. And I never trade a stock that's on the pink sheets. You guys might, but I don't. Now, this is really bad news right now. If the company doesn't turn around soon, and I mean extremely soon, it's going into the toilet. But wait, if that couldn't get any worse, there's some more bad news. They announced a a 50 million equity purchase agreement. They're selling more shares to get more money. And this is after the 16 million they just did not too long ago. So they got 16 million. They sold off a part of the company and now they're getting $50 million. So they're just trying to crank some money to have some cash on hand to pay for their negative earnings. So now, this isn't going to be a good thing for current investors. It's not. I mean, if you keep diluting and diluting and diluting the shares, you're never going to get that $1 share price, especially now that, you have less than a year to do it. But you know what? Let's look at some of the fundamentals of the company right now and see exactly what's going on with it to see if anything changed in my mind regarding this. All right, so the company is currently trading at $80 or $80, 80 cents a share with a market capitalization of roughly $93 million. Now, the first thing I want to look at, which is the valuation measures that are the most appropriate for this company to see exactly to compare it against the industry and the peers. Since the company definitely has negative earnings, the price to sales and the price to book ratio is the most appropriate valuation measures. So it looks like a good value now that it's been beaten down with a price to sales ratio of 0.4 times compared to the industry average of 0.8 times. And it's good compared to the peer average of 0.4 times. So it's pretty decent with its valuation now being beaten down. Now, if you look at the company's earnings and revenue, historically, the company has significantly increased the revenue in the past year from all the acquisitions they did in 2021. But the earnings are significantly lower, well, with a net profit margin that is a negative 39%. Now, they do have high growth revenue, though, right now. And it's increasing 42.4% per year is the forecasted. And here's the thing, the forecasted revenue, if it doesn't happen, this is not going to be a good stock to be into. So we'll see if their forecasts are actually accurate. And I'll get into why in a little bit. Now, the earnings are forecasted to grow, but more slowly and then get better over the next year. So revenues are going to go like this, projected, right? Let's cross our fingers on if that projection is actually accurate. And then the earnings are flatline negative, beep, 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 beep. And then it's supposed to go up and possibly become and break that profitability, that magical profitability mark that they've never been able to get to. And if this company doesn't get profitable next year, I would never even touch it. But all right. But let's look at some of the other, metrics, basically, since, we looked at the valuation. Now, well, first off, by the end of 2023, the company should have approximately $498 million in revenue with only negative $7.3 million in earnings. Now, that's possibly because when you look at the historical perspective of the revenues and earnings, it's all over the map, all over the map. They ride the waves of contracts and then they get no money. They ride another wave of a contract and then they get no money. That's the story of this company. Now, let's just look at the books real quick. The specific financial strength, which is extremely weak. First off, the short-term assets do not cover its short-term liabilities, nor its long-term liabilities. Now, the debt to equity ratio is 475%. That's considered extremely high. And its debt to equity ratio has increased from 22% to 539% over the past 5 years alone. And it only has a cash runway for 10 months. Now, that's based on the last reported free cash flow. But since then, they've raised that additional capital, $50 million. And I don't know if that took into consideration the previous 16 million. But let's just say they have a 2 years runway, possibly. We'll see it on the next quarter, on the next cash flow model. And it is important to note, though, it's interesting. Insiders have bought more shares than they have sold in the past 3 months alone. That's kind of intriguing to me. Maybe they know something we don't know. Maybe they believe in their strategy. Possibly. Now, the biggest thing that I've noticed over the past year is the dilution of the shares. It's been substantially diluted in the past year, with total shares outstanding increasing by 84%. I would never invest in a company knowing that over the next year, they're going to issue 84% more shares. But they have. They need to stay afloat. This is, to me, it's their last ditch effort on getting to profitability. Because if this doesn't work, I don't think the company's going to survive very long. That's just my personal opinion. So what did the analysts say about this? And this it's kind of interesting. There's only one analyst out there. I don't know his name. It just says one analyst. ratings based on one analyst. He's a buy recommendation. He's a bull on this company. He has a $7 price target for this company over the next 12 months, with a low of 4 and a high of 10. This guy really believes in this new strategy. Now, going over one of the analyst reports I found, the Street Quant ratings, they have a sell recommendation right now on this company. Last date, August 22nd. And they said the company's weaknesses are in multiple of areas: deteriorating net income, high debt management risk, disappointing return on equity, poor profit margins, and generally disappointing historical performance in the stock itself. Let me bring it back over here. Now, I got to say, it's not looking good for me, but hey, I might change my mind in a minute, you know? So on my buy, hold, or sell recommendation on Orbital Infrastructure, here are my thoughts. First off, you know, I alluded to it, but what exactly does the company do from a simplistic standpoint? Because you got to look at their operations and the revenues that they're coming from. I can sum it up by this business is that they're the contractors that make the projects happen with the infrastructure. Yes, I know that's a generalization, but let's just try to keep everything simple as we do this analysis. So there's buildings that need to be built, infrastructure, all infrastructure, and they do it. They ride the waves of the contracts for the past years and years and years. When the tides change, so does the revenues and future projections for their services. Can they change that? I don't know. They will scale up and scale down with market and political conditions. Now, my second question I would like completely answered is, what is the clear path to profitability for the company to get profitable? Because that's what we're here for. We're here to invest into companies that are profitable. This company has not been profitable for years and years. The bottom line numbers are getting worse and worse. Their revenues over the years were all over the map. But then let's fast forward to the end of 2021, going into 2022. That was the year that they transformed themselves. They morphed. They now had acquisitions, a bunch of them. Beginning in April 2021, the company transformed its infrastructure strategy with the acquisitions of GTS and Frontline Power Construction, the company's telecommunications and electric power segment platforms, and as well as a synergistic tuck-in acquisitions, the IMCO, Full Moon Telecom, and Cox Fiber, and they got rid of the legacy Orbital Gas Systems business. Now, the company believes it is positioned to be profitable, to profitably grow its infrastructure services platform for years to come, organically and through synergistic acquisitions to capitalize on the strong multi-year end market drivers in the industries they serve. And are we to believe this? Historically, they've been just corrupt. They've been pooping on us for years and years and years as investors. Are we being lied to? Not lied to, but are their projections kind of off? Or should we just write off the company, right? The next couple quarters to me are the make it or break it moments for this company. However, in one sense, on one hand, it's make it or break it. But on the other hand, the stock's sharp decline last year definitely is a positive for future investors if they turn around, making it cheaper in proportion to its earnings over the past year than most of the stocks in that subset sector. Now, 2022 is poised to be a transformative year for the company with an almost 5 times expected revenue growth compared to 2021. It was amazing. So far, their revenue growth has just spiked, but their earnings have dumped because they have to invest money to get those revenues, all those acquisitions, all that money invested in those companies. Now, hopefully, we'll see how it works out and see if 2023 actually goes like this with their earnings. So based on all of that, I'm a highly cautious speculative buy recommendation. I just changed my recommendation from a strong sell a year ago to a very cautious speculative buy. recommendation on Orbital Infrastructure. Now, I put a 12-month price target of about $4 a share, but I would wait to buy this until it gets back down to 50 cents a share. I think the 50 cents a share price, I think that's the support line that it's going to run into getting down. Now, if you purchase into this company, it's a highly speculative bet. Now, you're going to have to watch every quarterly report that comes out. And if the path to profitability remains elusive, I mean, for instance, the projected revenues for the end of the year should be totaled $427 million with negative $84 million of earnings. And by the end of 2023, the revenue should be $498 million with only negative $7 million in earnings. That means they're significantly going to get out of the hole within 1 year. Now, if these projections do not happen, I would recommend everybody drop this stock like a bad habit, you know, because they have up until July 2023 to get their stock above the $1 a share or get delisted. The last thing that they would do to keep this from happening is a reverse stock split. And by the way, folks, a reverse stock split never is good long term. And by the way, when somebody's stock price, let's say it's $20 or $30 a share, and they're losing money, well, they have a long time to dilute before they get to $1. They're at the $1. This is make it or break it. But what are your thoughts? Are you going to take a highly speculative bet on the company that has been fundamentally in the hole for so many years and take a chance on what I consider their last ditch effort to bring this fledgling company back to life? All I got to say is you're rolling the dice and could ultimately end with losing most of it if this company can't make it happen in the next 12 months. But I think it's hit a mark right now at 80 cents. I don't think it'll go anywhere lower than 50 cents in the near term over the next 6 to 8 months. So I think we're pretty safe with that price. But what are your thoughts? Please leave your comments down below. I definitely want to hear everybody's opinion on this one, because either bull on they can do it, or you're a bear that says, yeah, they're going to just historically do exactly what they've been doing for the past years and years and years. So there you have it, folks. And as always, don't forget to smash that like button down below. Definitely helps. And consider subscribing and hit that notification bell if you like your daily stock reviews from an unbiased source. Until the next stock update video later today, folks. Ciao.